Hi everyone, Tom Kuhn here, founder and CEO of Qnity and in a past life a CPA. For a lot of salon owners, leaders, and industry professionals, the financial side of the business can feel like a foreign language. My goal in this video is simple, to give you a clear, visual, working understanding of the three core financial statements, especially the P&L, so salons and spas can make smarter, more confident decisions with their numbers. Think of this session as the owner's manual for salon and spa finances. Let's dive in. There are three essential financial statements every business needs: the profit and loss statement, or P&L, the balance sheet, and the cash flow statement. Each one answers a different question about the business. The P&L asks, did the business make money? The balance sheet asks, what does the business own and what does it owe? And the cash flow statement asks, where did the money actually go? We'll spend most of the time on the P&L because that's where the profitability really shows up. But let's start with the full picture. Imagine a simple formula. Sales minus expenses equals profit. This is the P&L. It shows what happened over a period of time, a month, a quarter, or a year. Think of a P&L like a movie. It's a story with a beginning and an end. Here's what's included. It starts with money in. This is sales, also known as revenue, and includes service and retail sales. Then you have money out for labor, products, space, and other operating expenses. The P&L breaks your money out into two sections, cost of sales and operating expenses. Cost of sales includes service payroll, professional supplies, and the cost of retail sold. Operating expenses includes non-service payroll taxes and benefits, as well as your space costs such as rent, and a long list of other operating expenses such as marketing, credit card fees, education, repairs and maintenance, and more. On the bottom of the P&L is an other section that includes just a few areas of money in and money out, unrelated to the operation of the business, such as interest, depreciation, owner's compensation, government aid, and unredeemed gift cards. More on this section later. Stack all these in the right order, you'll get three types of profit: gross profit, net operating profit, and net income. We'll break those down shortly. The next statement is the balance sheet. Think of it like a still photograph, taken at a single moment in time. No beginning, no end, just here's where you stand right now. The formula is assets minus liabilities equal equity. This equation is misunderstood more than any other financial concept in the professional beauty industry. We've surveyed hundreds of owners. 86% get it wrong. Let's simplify it. Assets equal what you own, which is cash, inventory, equipment, furniture, trademark, customer lists, etc. Liabilities equal what you owe, loans and other forms of debt, accounts payable, unredeemed gift cards, etc. And equity equals the difference. It reflects what's been invested, what's been earned, and what's been taken out in owner draws. A personal comparison would be a net worth statement, which is needed, for example, when you buy a home. It's the same concept, your assets, liabilities, and the difference. Why does the balance sheet matter? Well, it represents the true measure of business health and reflects all the history of the business. Profit doesn't equal cash, and the balance sheet is where you see the gaps, especially around inventory and gift cards, two of the biggest trouble spots in the beauty industry. Now let's talk about the cash flow statement, an underused statement for most small businesses. Think of the cash flow statement like your bank statement, but for the whole business. It accounts for all the money in and money out of a business, including things that don't show up on the P&L. Your cash flow takes into account loan proceeds and payments, owner's draws, large expenditures like a build-out, and gift card sales. Here's the formula. Beginning cash plus deposits minus withdrawals equals ending cash. That's it. Most small businesses run their businesses by checking the bank balance. Functional? Yes. Financially sound? No. If a business wants predictable, repeatable profits, they need to understand cash flow, not just profit. As the saying goes, sales is vanity, profit is sanity, but cash is king. Let's zoom in on the P&L. Imagine your P&L unfolding on the whiteboard like a map, chunked into categories that stack logically. Here's the flow. First, sales, which is service plus retail. That's money in. It's positive. Then we deduct cost of sales. These are direct costs tied to producing revenue. This includes retail cost, professional supplies, and the largest single cost, service payroll. Sales minus cost of sales equals gross profit. This tells you what's left after you've paid for the things that directly create revenue. Next, we have operating expenses. These keep the business running. Other labor costs made up of non-service payroll, payroll taxes and benefits. Non-service payroll includes front desk and leadership. Space costs include rent, utilities and repairs, credit card fees, also known as merchant fees, marketing, education, technology, insurance, accounting and legal fees, and other expenses, usually under 1% of revenue. When you subtract operating expenses from gross profit, you reach net operating profit. This is a key indicator of business success. It's the business's profit before financing costs, owner's compensation, and other monies unrelated to operating the business. Deducted from net operating profit are non-operating expenses, including interest, depreciation, and owner's compensation. There's also other income that's added here. Non-operating income can include unredeemed gift cards and government aid. So after you account for all the other income and other expenses, you have net income. This is the final number, the ultimate truth teller. In our industry, the average net profit is about 5%. The businesses performing in the top tier have double-digit profitability, 10% or greater. These businesses get there intentionally, not by accident. For multi-location businesses, the rows of the P&L stay the same, but the columns multiply. One column per location, another for enterprise totals. When a business scales, seeing location-level profitability becomes essential. It helps identify which locations are healthy and which need support. Let's bring this lesson home by reviewing the equations for the three financial statements. The P&L, sales minus expenses equal profit. The balance sheet, assets minus liabilities equal equity. The cash flow statement, beginning balance plus deposits minus withdrawals equals ending cash. If you walk away remember these formulas, you're already ahead of most. Financial statements aren't meant to intimidate you. They're tools, powerful ones, and they give you clarity, control, and confidence. And once you understand these statements, you're not just reading the numbers, you're reading the story of the business.